because we should be good right now.
So it works. Okay, super.
All right.
Thank you, Rüdiger, Andreas, Alex.
YouTube.
Okay.
YouTube.
Okay.
Everything looks good. Okay. Phew. When it rains, it pours with those technical issues, right? I'll see if I can, and I'll see if I can edit the YouTube to kind of make it look like we're perfect, at least. Although I would say I blame GoToWebinar on that. I've never had that happen before. But let's go ahead and get started. As I was saying before, to just Jay, the very handsome Jay Medro is joining me. I think he's right here on this side. For me, he might be above you or below you. It depends on kind of how you're viewing this. I want to welcome everybody for coming today. It's good to have you. I do have a little bit of a legal disclaimer that I'm going to run through. Some questions that we also always get is, do I get a recording of this? We will be sending a recording to you. That'll go to our youtube.com/MetaStock site, and it'll be sent to you within about an hour after the presentation is done. Hopefully, if we didn't break that too. So from a perspective of that, if you like the video today, make sure to like and subscribe to the YouTube channel. It helps a great deal, and I appreciate it. So let's go to that legal agreement that I promised. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock and its employees and its guests shall have no liability for any investment decisions based on the use of the software, trading strategies, or any information provided in connection with the company. MetaStock and its employees and its guests do not endorse the purchase of a security, nor are they paid for the promotion of a security. No information contained in the presentation should be construed as investment advice or the solicitation to buy a security. So our guest today, this is a little bit out of the wheelhouse for me. I'm very, very good at technicals. I don't know a lot about macro fundamentals and macro global economics. So I'm very, very excited to see what Jay has to say. This is the first time I've actually listened to you do a presentation, Jay. And so let me get you started. Let me go ahead and turn the presentation over to you. I'll make sure I can see everything. Everybody will let us know if they can't hear you. And I have a feeling it's going to work, though, from this point on.
Perfect. Super. Thank you so much. So let me
Andres says, hello, coach. He says he can hear you nice. Alexander says, thank you. Andreas says, yes. And then Nico says, yes. So everybody can hear you. Angelo says he has to leave a little bit early, but we will send you a recording, Angelo. I can see your screen. I can hear you. So I'm going to get out of your way. Your turn. Go.
First of all, thank you for having me. Thanks to MetaStock. Thank you, Jeff. Thanks, Lynn. Thanks, Stephanie. The whole team at MetaStock. We have been a user and also in business with you guys for a few years now, and is one of the essential tools that we use every week. We did change from the last version called Zenith. Now it's called Workspace. So thanks to our traders and thanks to your firm here very officially on YouTube for making that change over so smooth for us. If you're watching this and you're one of our traders and you don't have the new templates, please write to us, support@libertybrothers.com, and then we will hand you over and tell you how to do it. So today's topic is going to be global macro signals, navigating cross-asset trends and building income trades. It's a little bit newer. Our company is called Liberty Brothers, and that is based upon me having worked at Lehman Brothers. So you see the same kind of type font, and success starts by investing in yourself. 2016, back in Germany, I started an educational business after having tried to retire from investment banking. I was a bond trader and later ran sales into Germany and Austria for some of the largest investment banks in the market. So Lehman Brothers, Societe Generale, Nomura, so some pretty big players. So based on my career, it culminated into a process that we call the FIS process, where we look at fundamental intermarket sentiment and technical analysis. So while Jeff and some of our YouTube watchers today may be very familiar with technical analysis, the markets have evolved, and to gain an alpha / an edge, it helps you to look at everything. The markets have evolved. So our risk disclaimer once here in English, and then another time in German. And then for the futures trader amongst us, CFTC rule 4.41 says, backtests are hypothetical in nature, important for you to hear it and to understand. They say nothing about the future. When we had Liberation Day, April 2nd this year, no Citadel macro fund, no algorithm, no quant model was prepared for this type of market reaction because there was nothing to model. We haven't had that in over 70 years, these types of global tariffs, and to basically bring into uproar the entire global trade routes. So it was very difficult to model, and the market took a few days / weeks to find its footing. Currently, September 3rd today, we are trading at or near all-time highs. On the other hand, we have the gold market at all-time highs. We have what we call a reflation trade, which may or may not tell you anything right now. This is something that's the topic of today that I would like to introduce you to. So before we get started on that, let me tell you a metaphor. The market, maybe you're just trading euro dollars, maybe you're just trading Bitcoin based on technical analysis, maybe you're just doing options. The market has, like the weather, a season, like spring or fall or summer or winter. And depending on the season, certain assets perform historically better than others. So when I give a seminar live, for example, in Austria, and I ask the room, how many of you have ever invested in bonds? Usually very few hands go up. Yet when we have winter in the markets as a very opportune time to make your yield, generate your performance in bonds. Very different from always being long stock, from being a cost average basis investor in stocks or holding your mutual funds. You can be a little bit more of an active investor when you have the correct knowledge. And today's agenda, I would like to give you a little bit of a taste of this type of knowledge. If you look at this lady here, this is actually my setup. This is what I look at. I live on the beach. I look at the ocean, and the markets have been kind enough to me to provide me this type of lifestyle. What is my problem? I can't retire. I tried it again in 2023, and after half a year I got tired, and then I was fortunate enough to now be able and allowed to work for Liberty Brothers and to help people who are interested in or share our passion about the markets to actually learn how the markets function and how you can, either as an active investor or if you're so how can I say, hyper motivated to become a trader. And I could talk for hours about that. The type of trading that you as a retail trader may imagine exists out there, it doesn't exist on the institutional side. It doesn't exist. Nobody sits there and looks at footprint charts, and nobody sits there and looks at candles. It doesn't exist. As a bond trader, I didn't have any charts. So back to the topic of today. I would like to introduce you to an economic surprise index that Citigroup developed and that MetaStock Workspace offers us the data and the graphical depiction of that. I would like to give you a quick introduction into the yield curve, which for me is one of the most important intelligence pieces of information that the market gives to us. And as a former bond trader, I'm happy to share some of my insights with you. And then volatility. Volatility is extremely important for us. Next to determining, is it spring, summer, fall, or winter in the market, we also parallel try to determine in what type of volatility environment are we, because that again lets us know if we want to have cash income generation via options trading, or if we want to go aggressively and invest, or passively and go more into risk management mode. And then would like to try to show you that the information that you get from different asset classes translates into signals for you to trade in the different assets. Potentially you're an FX trader like we are. You can trade that. Potentially you're an equities trader like we are. You get signals from the cross asset market analysis to trade in your equities. Maybe you're a bond trader like we are. Then you can trade the curve, steepening or flattening. I'll get into that in a second, or outright bonds. Now you notice, and you might have said, Jay, you just said you're an FX trader, an equities trader, and bond trader. Yes, we trade absolute everything. We are what we call a global income investor. That means we position ourselves before volatility hits anywhere in the world. Like recently, we were long Europe, and we are now looking to short Europe, not only in the FX market, but also in the different ETFs. We were long India this year. Now we're short India. So as you can see, as an active investor, depending on the economic development of a certain jurisdiction, country, economy, we can switch sides. So we are not married to a position. We are active, but I wouldn't necessarily say we're intraday traders. Trade and income signals, turning macro signals into actionable trades. And those of you who are here tonight or today in the webinar and who know me, they know that I don't have the ability to talk nonsense. I mean, I might in the private life, not in my job, not in this profession. So we're not talking about shoulder, head, shoulder, doesn't exist. And I don't have the ability to waste your time. If you're giving me an hour of your time, I will show you actionable trades or potential investments. Noting, according to the disclaimer, I am not allowed to give you investment advice. I'm not doing that. I'm sharing what I do for you to learn or be better informed, okay? So very important, we're not here to give trading or investment advice. And then we go through some case studies that may be of interest for you to see how it's done in the past and how you can replicate that on the right-hand side of your screen, because it's always easy to show stuff in the past. Again, if you know me, my YouTube channel, or have worked with me, I always do things on the right-hand side. To teach, I go into the past, but then after teaching in the battlefield, on the battlefield, in the trenches, we always go on the right-hand side. But your brain has to see it once to understand it, what it looks like, so that it can anticipate it on the right-hand side of the screen later. Okay, the economic surprise index. Why do economic surprises drive markets? Here's a key thing for you. Everything that you're seeing, regardless of where you are in your career right now, everything that you're seeing in the charts, for example, is the outcome of macroeconomic modeling. Macroeconomic modeling. So the game is about, can you model what, for example, economic growth in the United States of America is going to be like in the next 2 to 3 years? And can you model what the development of inflation is going to be like in the next 2 to 3 years? He or she or whatever bank or hedge fund or quant who models this the best, the most accurate, with the least tracking error, so to speak, makes the most money. That's macro. Based on macro, you then go into micro. Can you, for example, model Apple's expected earnings over the next 12 months better than Goldman can? If you can, and the cost development and the environment, then you win. And you win even more if you invest in Apple, if Apple is traded, invested in at a macroeconomic environment where we have summer or spring in the market, meaning where you have economic growth and where inflation is behaving. So if you hear economic growth and development, expected development of inflation, you have a foot in the door. So if the market is positioned, everybody, the big money is positioned according to their macroeconomic modeling outcome. What does that mean if economic numbers come, for example, differently than expected? We had that this week. For example, in Australia, GDP was expected to come in at a certain number, and GDP came in much higher than expected. So if you look at this, for example, this is strength versus weakness. This is the last week, and you see the strongest FX right now, the strongest currency for this week is the Aussie dollar. there's certain determinants for that. Why? We saw the economic numbers out of China this week come in better than expected. It's a very important trading partner for Australia. And then the economic numbers for Australia come in better than expected. So the macroeconomic models need to update in real time, and more institutional money is realizing, oh, I am not long enough Aussie dollar. I need to increase my long position. In the UK, we had a different narrative right now, which I'll show you in a little bit. And that narrative is, wow, the new government has fiscal issues. They're not generating enough revenue. Their costs are exploding. And the refinancing rate, the government borrowing money in the capital markets in the long end, is going through the roof. So the cost for UK to borrow money in the world is going up because their credit worthiness is going down. Imagine, for example, Tom, you have that. You lost your job, you're going to the bank and you're trying to buy a new house. Do you think that your mortgage rates will be higher if you get a mortgage at all, or lower after you've lost your job? Okay, so I'm trying to give you a picture. So it's very easy for you now to understand economic numbers coming in better or worse than expected causes macroeconomic models for the big funds on earth to update, causes signals being sent to portfolio managers. I'm not long enough Aussie dollar. I am too long pound. And then you have the trade. And now, Jeff, I invite you to go into your chart and look for a pound Aussie dollar short. And in that chart, you can do whatever you want. I don't care. You can do Fibonacci, you can do this, that, or the other. I don't care, because the pound versus Aussie dollar is going to sell. Give me a yes in the chat if you're starting to understand what I'm trying to convey to you. The world is based on macroeconomic models. It's not based on, I'm seeing a technical pattern and that technical pattern tells me that it's going to go up or down. That's not how it works. So if you understand that, you become you gain a better understanding of the tools that Workspaces gives you. So Citigroup came up with the Economic Surprise Index, and it measures these types of surprises that I just tried to allude to. These types of surprises where, I'm trying to give you an example. So we're going into the Economic Monitor in Workspaces. Live. What's this? Florida to end all vaccine mandates, including for school children. Interesting. Okay. And the next one, India Council approves changes in consumption. Okay, good. So we can dismiss and we can close. So, for example, goods, services in Australia. So if we don't want the world, we take, for example, well, you click here. Like this, we were talking about China and Australia, and we're taking the rest out as an example, okay? So you update, and we're seeing, here's a revision, building approvals were revised, and this is what's happening. You can here click if you want the very important ones, the medium-sized important ones, or the very, and you can see that the actual came in. Expectation for the manufacturing PMI in China was expected to come in 49.5, and it came in 50.5. With the services PMI 52.6, 53, it actually came in. GDP, and this is prices, real GDP quarter on quarter was supposed to grow by 20 basis points, came in at 60 basis points. Voila. So your job, even if I give you like this type of chart real quick, and you can do it in como se llama, Workspaces as well. You go to pound Aussie, pound cut, pound Swiss. Where's pound cut? Pound Aussie, pound New Zealand. Come on, I'm not seeing it. Pound Aussie, here we go, it's right in front of me. So pound Aussie, selling off. Selling off hard into today's session, into liquidity, but this is the trade of the week, right? because numbers came in different from what the expectation was. Positive current city economic surprise index, and I'll show you a picture in a second, means usually a stronger currency, very positive, for example, the Australian numbers. So I would be looking for the Australian ETF called EWA to be playing that from the long side. If you now utilize technical analysis, you would be going into your chart and looking to go long for that one, buying retracements. Negative CZ, actually CSI, means the opposite, weaker currency, risk off. So here's an example from the recent past, January 13, 25 until July 2nd, 25, we had economic surprises in the US underperforming. So the macroeconomists that were modeling, and they said GDP is going to come in like this, and inflation is going to come in like this, and then data points came in weaker than expected. And on the other hand, you had in UK positive surprises in the same period, Jan 13 until July 2nd, positive surprises, positive surprises. So again, if you know how you can utilize the chat, write to me. The Forex pair is called pound dollar. In which direction would you expect the pound dollar to go during that time period? I know we're looking at the past, but I'm trying to prove to your brain that economic development works. I'm trying to see a chat. If anybody can type anything. Alex, maybe you can type something so I can see it. If anybody's typing anything, or maybe the chat's not working. That could be too. Last thing I saw was Andy writing 100% yes. Or maybe the chat function doesn't work. Jeffrey, I don't know if you're here.
It does. We do have a, if you want some questions, we do have some questions.
Besnick is there, perfect. No, I can see the chat. You don't have to read it to me. So pound, dollar would be going long.
We do have some questions when you're ready for
it. GU short. Rüdiger, think about it. So we have the pound going, economic surprises going higher, and the US dollar with a slightly tilt lower. So it would be pound long, dollar short, right? So pound dollar long. Okay. Citigroup then said, wait, if the game is economic development, but we're also looking at the second component, and that is the development of inflation, maybe we can get a more nuanced picture if we also build a city economic inflation surprise index. So they did that. And here you can see that the inflation was coming down in the United States as the economic surprises were coming down. What type of environment is that? Okay, very simple. You actually only have 4 possibilities. If the 2 variables in any macroeconomic model that's looking at macro is modeling either the economy growing, being stagnant, or going sideways, and the other component is inflation. And in economics, pi is the placeholder for inflation. So the spring after a harsh winter, you know, when we're starting to grow again, but inflation is still low, this is where you have the economy growing, but inflation is still down to sideways, okay? This is called the spring. Then you have the summer, where the economy is growing and you have the inflation growing slowly, all right? We call that the reflation trade. That's the summer. Then it's almost like a sine curve. It starts leveling off. What's happening is that the economy cannot continue to grow and grow and grow and grow and grow. There's a mathematical concept that's called base effect that's starting to kick in, but the inflation is still high or keeps on rising. That is an environment that we call fall, or the economic term is stagflation, a stagnating economic growth, but inflation that's still high. This, for example, is an economic environment where gold is outperforming immensely. And then you have the winter, right? When your economy is tanking, and that is causing price destruction because the consumer lost his job, the consumer doesn't have any income, the consumer used up his or her savings. Without any money, he cannot consume. 70% of the US economy is made up of the US population consuming of the consumer. So it's massively expensive. If they can't consume, what do the stores do with their goods? They reduce prices. So inflation is coming down. This is winter. This is not the time to be in equities and stocks. This is the time where you actively want to get out of stocks and you want to go into, for example, bonds. So far, so good. I know my team knows this, but for the new guys, Whitney, for example, or Tom or Roy, am I telling you something new, or is this already all known? Because then I can speed up a little bit. So what we had in the US is if the economic surprises are getting worse, and if the inflation is coming down, you have winter, yeah? You have deflation in the US versus, now I need to get another pen real quick, versus in the UK, what did you have in the UK? You have economic surprises, so data points are coming in better than expected, and you have inflation surprises that are coming down a little bit. So what do you have there? There you have spring. Okay, you have the so-called Goldilocks scenario, economic growth and inflation behaving or even coming down a little bit. So this was clearly a time where you want to be long the pound and clearly a time where you're not long the dollar, maybe even shorting the dollar. So far, so good. William, with me? Whitney, with me? Very, very important, because depending on this, and again, Workspaces gives you this indicator, I'll show you in a second, you know that from January 13 until July 2nd, you're looking for long trades in the pound, long trades in the pound. So the fundamental understanding in the backdrop, how the markets work, portfolio managers waiting for new information, data points, or sentiment shifts, and you knowing in the background that the UK is in springtime and the US is in the winter time, this gives you confidence that when the market retraces, that you go long. That's why I built this whole thing, to give you more confidence that you know, okay, I can trust this retracement. I know in the background, this is a stable growth environment in the UK. And the nice thing is about FX trading, that if an economy is growing, it's not growing Tuesday at 11:37 and then Wednesday at 8:09, it's contracting. It grows over weeks. If the inflation is increasing, it increases over weeks and months, maybe even quarters. You look, for example, at the economic projections from the Federal Reserve, they are going over a projection horizon of 12 quarters, so 3 full years. And by the way, I highly suggest you read the Fed report and the projections for economic growth, because these are the guys that determine how expensive your mortgage will end up being at the end of the day. A yield curve is always being steered from the short end, and the Fed decides how expensive or cheap the economic commodity called money is. They decide the interest rate. It's new, but I understand. Super, Whitney. Thank you for your reply. I appreciate that. I want to get you involved. Okay. So if we look at trade management and scaling in, maybe Jeff likes this. Let me get, okay, I'm first going to do it like this. So what you see is, this is our, we know economic, we know the direction, fundamental direction. So what we're seeing is a pin, meaning buy limit orders that are pressing, something that I could, in the future, Jeff, maybe you're taking notes, I could explain what's actually happening in the market here. So you see an accumulation, institutional accumulation long. We call this a break, a hook, and then a go. So I start, once the market trades above this high, I start going long, above this high, sorry, I start going long. And then you could even put your stop beneath the last swing, knowing almost everybody is there. Almost everybody is there. And that's okay, because it's a fundamental strong uptrend. So the next time you see again, you see the break, the hook, and the go. So maybe you want to add to your long position. Could be. We always test for opposite side liquidity. So where's the swing high? Here. So if we go into the swing high, we expect follow on, and then we expect a test of that former swing high. And if the economics, the fundamentals are still unchanged, we're going long, then we can add to the position here, and we can add to the position here, and you see how we're trailing our stops. We're basically reinvesting money that we're making from a positive trade. This is very normal. Institutionals scale into their winners and they scale out of losing positions. Why? Because capital has to work for us. Capital allocation, the scarce resource called money, has to work for us. It's unacceptable that we are sitting on back holding positions. We call that the back holder, you know, like, I don't know, Nvidia goes down like hell and you're holding on to it forever. You know, a Tesla tanking on you. Risk management is everything. You become unemotional. Even if you're emotional, you still have to risk manage the position. All right, break, hook, and go. Yeah. We see another breakout. We see a retracement. As soon as I'm trading with a buy stop above this swing high, local swing high, I'm going long again. And I'm trailing my stop up. I'm sure you've seen this a million times. It's very simple, and here's something interesting happens. Prepare for what we call an end of trend at Liberty Brothers. First of all, the fundamentals have changed. The theses are switching. That's the first thing we're noticing. The second thing we're noticing is, okay, what is happening? What's happening is that we're making a lower high and we're holding this position, and then all of a sudden we're breaking down on a slight increase in volume. So as soon as you break down, because the fundamentals have changed in the background and you're reading the session reps and you're in your workspaces and you are reading the articles actually that you are seeing, for example, in the news, yeah, to get a better sense and understanding of what is happening, and you're following the economic calendar and you're seeing the CFTC that is coming down, for example, this is the time where you are managing like a professional. You're seeing that the data is changing, and when the data changes, your position changes as well. So if we go into the live chart here, for example, we're going to take a look at it together, and you're just going to give me whatever you're seeing, a country where you're saying, okay, that looks good right now. We're going to 6 months. That looks like it's accelerating. Maybe I'm interested in playing that from the long side, and tell me one that's decelerating where you're saying, maybe I would put that currency on the short side. What are you seeing? Whitney, are you seeing anything that, and we're looking for drastic moves, drastic meaning steep angles, either steep up or steep down. What are you seeing? For example, in the US, I'm seeing, wow, it's actually positive development in the US economy. Europe versus Europe is actually stalling. It looks like the economic surprises are stalling. UK, stalling. Aussie came from a low and it's really accelerating. So data is coming better than expected. Canada, stalling. Japan coming off, there's a steep angle pointing down. So we have surprisingly bad data versus the macroeconomic models. Swiss, surprisingly positive data. New Zealand, range bound. China, turning slightly. So Besnick says, for example, Swiss long and yen short. Love it. Absolutely love it. Swiss long and yen short. And the next thing you would then do is you go into a chart. Forgive me for taking this chart, this software, it's just quicker. Swiss versus yen is right here, Besnick. So playing that from the long side. It was already long. We just had a break. We're coming down on a hook. Former resistance is now support. This could actually be a trade that we're putting on. Now the next thing is that going to cost you money or not? Is it positive or negative carry? Because if you're trading Switzerland long, you are generating 0% interest rate on the nominal that you're holding Swiss long. And Japanese yen short, you're going to pay the interest rate. So it's negative carry. It's what you make versus what you pay is negative. So that's something you have to keep in the back of your mind. It's a small amount, but if you hold a position for a very long time and it's a large position, it's going to make a difference in your account, okay? And then since everybody on Bloomberg and Reuters is talking about inflation, well, how bad is inflation and in which economy is it really bad? So we're asking the Citi inflation surprise index to give us an update on that. We're waiting and waiting and waiting. Okay, so inflation is rearing its ugly head again in the US. It's tame in Europe. It's increasing again in the UK. It's coming off in Australia. It's increasing again in Canada. It's really coming off in Japan. In Switzerland, it's increasing again, increase. So it's a mixed picture. But if we look at Besnick's trade that he just said, long Swiss franc and short the yen, Swiss franc long, short the yen. This is supported by the development of inflation, and it is supported by the development of the economic surprises / disappointments. And the chart is telling you, super, I'm at former resistance, now potentially support, let's go long. So this is an actual trade right here that we looked at together. Thank you, Besnick. It's one of our best traders, by the way. He was just flown into, where were you? In Dubai, right? Because one of the prop firms put him on YouTube, on their YouTube channel for marketing purpose, because he made so much money. So congratulations again, mate. Good job. So why the yield curve matters. We're moving on. The yield curve. Now, what is the yield curve? Well, if you look at, for example, I'm going to go into this in a second, but if you look at yields, okay, this is the 1-year yield in the United States of America. If you borrow money or if you lend the US government money, you're generating 3.774% coupon per year, yield per year. The 2 years is 3.6, the 3 years 3.57. So it's interesting because, let me go back to Whitney. Whitney, I'll come to you and I say, hey, can you please lend me money? Then you say, how much? For how long? And I say, for 1 year, and I need $1 million, okay? Versus, Whitney, I'm gonna borrow some money from you, please lend it to me. I need $1 million for 10 years. Now I'm asking you, what is the higher risk for you? Is it more likely, is it less risky for you that I pay you back in 1 year or in 10 years? What is the risk that something can happen to me in 10 years? So normally you would say, in 10 years, maybe a truck hits you, maybe you smoke a lot and you die, who knows? I don't feel comfortable lending you for 10 years at the same rate as for 1 year. So normally, naturally, I would hope that you say, hey, look, probably a normal yield curve shape is that the longer we lend, the higher the yield. Does that make sense to you? Okay, Angelo, see you later. Angelo had to run, okay? And what's interesting is that we're seeing that in the US right now, the short end is higher, 3.7, 3.6, 3.5. The 1 to 3 year is inverted, and then from 3 to 5 year, it's a normal yield curve. From 5 to 10 is normalizing. From 10 to 30 is normalizing. In the short end, we're seeing something interesting that, and this is exactly the discussion right now that Trump is having with the Fed. The Fed is refusing based on its tariffs and the so-called sticky inflation to lower the interest rate. And the Fed is saying, if the employment situation gets worse in our economy, then we're willing to start cutting rates in September. But we need to see the data first. So the Fed is data driven. The hedge funds are data driven. Your insurance companies that invest your money for you are data driven. The entire market is data driven. It's all mathematics. Nobody looks at any kind of chart per se. But we do look at the yield curve and we look at the shape of the yield curve. And when we have a normal yield curve, that means there's an expectation that the economy grows. There's an expectation that we have a healthy amount of inflation in the economy. The target is for 2% inflation. So if the economy is growing, and it's quite interesting, let me just show you real quick. There's the Atlanta Fed and there's the New York Fed. So I'm just showing you one real quick. This is the Federal Reserve Bank of Atlanta, and they're measuring in real time, it's called nowcasting, what the GDP growth is that they're modeling. So they're estimating right now that the third quarter of 2025, the economy is growing at 3% at the moment. And that is slightly down from last week where we were growing at 3.5%. Why is it slightly lower? Okay, I'm glad you're asking. It's slightly lower because every single time a new data point comes in and ISM manufacturing prices came in lower than modeled and economic optimism came in lower than modeled and job openings came in lower than expected or modeled, that goes right into the new macroeconomic models, this one from the Atlanta Fed GDP Nowcast, and it's saying the economy is still growing, but it's growing slower than we had modeled. Do you see how that makes sense? It makes sense. And if you then look, for example, at the dollar, and you're seeing interesting, this is hopefully the dollar, I can show you here. See, the dollar was going up. This is the dollar yen. 1 second. I just wanted to show you the dollar index. So the dollar index is trading in a range. It's in a range between 98 and then liquidity almost at 97. But if you have numbers coming out today, or important numbers like we have non-farm payroll this Friday, and if these are coming in really, really bad, then the likelihood that the Federal Reserve will lower rates to support the economy, to stimulate credit growth, will increase and the dollar will come down. Whitney, are you with me? Sorry that I'm asking you. I'm just hoping that you're understanding what I'm trying to say. So a normal yield curve implies economic growth and healthy levels of inflation. A flattening yield curve, either from, okay, this is the shape of a normal yield curve. 2-year yields are lower than 10-year yields. A flattening yield curve can either mean that the 10-year yields are coming lower or the 2-year yields are coming higher, or both. Depending on if it's the long end or if it's the short end that's causing the flattening of the yield curve, we say it's a bull flattening or it's a bear flattening. If it's a bull flattening, it means, ooh, this is really bad. Bond traders, who are the smartest traders on a trading floor, and then after them come the options traders, and after them come for a long time nothing, and then come the equity traders. That's sort of like the food chain on a trading floor. The bond traders are indicating that in the future, there's going to be trouble. The economy might be stalling. Inflation may be coming down. And what happens then, if that really manifests and happens, is that the bond market will start pricing in that the Federal Reserve may come and rescue. And how do they rescue a recessionary economy? By lowering the interest rate. So the short end of the curve is going to come down. The 2-year yields are going to come rapidly down. In the pandemic, for example, it went to 0, and that increases and steepens the yield curve again. This is called the bull steepening. So we have a flattening, and it happens late in the cycle, and that tells us, okay, in the future, we may have lower economic growth, we may have lower short-term yields because the central bank is lowering the yields. In an inverted curve, that means, attention, we might have recessionary risks, and we may see flight to quality. An economy that kept growing and growing was being tampered down by the Federal Reserve, if we take the example of the US, by increasing rates. They do this so that the credit growth will slow down. Your economy in the US is 100% based on credit growth, All right, it's a gigantic bubble. It's all about credit growth. The more credit, private or public, the government borrows money or you borrow money or your company borrows money, doesn't matter. Economy grows if we have credit growth. There's a differentiation. Your company and you are expected to pay back the loan. The government never. It's so big, doesn't exist. No sovereign is expected to pay back the debt. The only thing the capital market is asking is, hey, are you guys sound enough so that you can roll your debt? Meaning something comes due and you can refinance it in the global capital markets. Big differentiation, okay? Because a lot of people are out there and writing and sending you emails about how the world will end. It's been going on like that for a long time. The trade that everything ends has a very small probability to happen. I'm sure one day it will happen. Bible says so, but it's not a trading model that is repeatable and that will make you a lot of money, because you have to get that one certain spot right where it's actually all going to hell. So when the curve is inverted, we see bonds rallying, long end yields are coming down, the dollar strengthens because the short end of the curve is coming up. And I'll show you that in a second. Steepening of the curve, we call a reflation trade. Risk on assets, for example, like equities, are rallying. And here we determine between a bull and a bear flattener. When it is steepened, equities and cyclicals perform. And of note, before a recession, we usually see a strong bull steepener in the curve. Bull steepener means the short end is coming down in terms of yield, and that steepens the curve, and it's an expectation of the bond trader that the Federal Reserve will take the yields down. Why do these curve moves matter? Because the curve tells you everything at once. It tells you the expected growth of your economy, it tells you the expected development of inflation in your economy, and it tells you the expected monetary policy in your economy. All of that is priced into the curve and into the shape of the curve. So when you look again, this is a database from the St. Louis Federal Reserve. You can see here that the curve went inverted. So the mathematical formula here is that you take the 10-year yield minus the 2-year yield. I'll show it to you. It's 429. So it's 4.209 minus the 2-year yield, 3.608. 3 spot, what is that? 608. So the curve has a value of 0.601 right now. 0.601. So you go to the scale and the curve is somewhere here, and it would be one blue dot, boom, right there. And the next day, the curve moves. The 10-year goes up or down, the 2-year goes up and down. And when the 2-year starts going higher and higher and higher and higher, like it goes to 4% and 4.5% and 5%, I'm exaggerating, but the 10-year stays or the 10-year comes lower, do you see how that curve is inverting more and more and more and more? And that is like a brake when you're driving your car. You will decelerate. An inverted yield curve means, oh, someone is trying to decelerate the economy. And what happens is they not oversteer, but they overbrake, like a Formula One car, right? They overbrake in the curve and they crash the economy and you have a recession. Funny fact about a recession, you are always told in hindsight that we just had a recession. Technical definition is 2 quarters of negative economic growth means you have a technical recession. What you can see in the market is every single time that a recession hits, right before, in after hindsight, you're told you're in a recession, you see a massive steepener, and it's a bull steepener. We go negative, we're oversteering, the economy is having problems, the bond market is expecting, we are going into a recession, you see a bull steepener, and then you see the gray area afterwards, there was a recession. We go negative, inverted yield curve, you have a steepener, there was a recession. You go negative, you have a steepener, there was a recession. You get the point, right? What you see here right now, we go negative, we have a steepener, what the it's already 12. I don't know how much time I have, Jeff, but we're expecting a recession. We've been talking about this recession for years now, over 2 years. There is no recession. Mind you, it will come. In the last, how many years is that? 70, 50 years, the curve has never been wrong. And no, things don't change. So the curve is telling us, please be careful with buying NVIDIA at all-time highs. I'm not saying this is a short, I'm just saying it's interesting to have that information that we've been talking and waiting for 2.5, 4 years for a recession. And it would be even more interesting if it is the tariffs that will break the camel's back. It could be, because just today, when we looked at the numbers and some of the commentary given with the numbers, firms are having more and more problems passing on the increased costs to the US consumer. And these are increased costs, regardless of what the politicians are telling you. The tariffs are basically a tax. They're a tax on you as a consumer, and they're also a tax on the firms, your firms, because who pays the tariffs? Your firm. No Chinese manufacturer is paying the tariffs. They're just noticing less orders from the US, because when a US company orders manufacturing stuff, manufactures in China, and it comes to a US port, it is the importer who pays the taxes. And he's trying, that increased cost, he's trying to pass it on to you, the consumer of the product. And you will do that as long as you have a job. And if you don't have a job, exactly, then the economy is highly likely to go into a recession. So here's a case study that you can do, and that is actually quite valuable if you understand what this is showing you. What you see here is an ETF on industrials. The candles are the curve, the 210s. Here you see 0%. So once you touch 0%, or you go inverted, and then you have a re-steepening of the curve means the future will be bright. We have spring, and after spring, hopefully summer. So you want to be long industrial companies, for example, in the format of an ETF called XLI, which is the price development of XLI is the yellow curve. So again, you have a curve that went negative, and then after a few years, the curve finally goes positive again. It re-steepens, okay? Usually you would expect a steepening yield curve, better inflation, better economic growth in the future. You would expect a positive correlation with the industrial names in the stock market. Makes sense. When you see that you have a curve that is steepening and you have XLI tanking, that is a trade opportunity. And this is called a correlation coefficient. You can put that in TradingView. The moment that the correlation coefficient goes positive and the curve is steepening, you have a buy signal for XLI. Isn't that a very different type of technical analysis that I'm sharing with you? I hope so, because this is how macroeconomic modeling on a very basic level, this is stuff that is happening in the background. Correlations, logical correlations, okay? So at point number 3, the curve went negative. At point number 4, the curve goes positive again. You are in a positive environment. You're looking for longs as an investor. And here you have a great opportunity based on Trump's tariff day. The latest you want to re-enter a long is when the correlation goes positive again. And this is exactly what coincides with some of the technical breakouts that you may or may not see. Again, next to watching the economic development, I'm giving you a second puzzle piece here. You can watch the curve. You can understand that in a growing economy, you have healthy inflation and you have economic growth, means a steepening of the curve, a steeper curve. You can overlay an asset like the XLI ETF, and you can say, I want to be long. There's a huge drawdown, the Trump tariffs, I don't know what to do. You can wait until the correlation goes positive again, and then you have the opportunity to say, okay, now I want to go long XLI. Whitney, are you with me? And Rod, are you still with me? And Les, are you with me? And Johnny, all the new guys. Cry, are you there? Jeff, are you still there? So
where would I go?
Okay, super. You need to tell me if I go too long, okay? But I love sharing these bits.
We don't have an upper limit.
Awesome. This type of new information. By the way, the way to get the correlation coefficient is you just go on our indicators and you type in correlation coefficient, yeah, and then it asks you with what do you want whatever is up here on the left hand side. You can see US 10-year yield minus US 2-year yield, so that's the candle. And then what is this? I just hit add, and then I have XLI, that's the ETF for industrials. And if you want to have the correlation coefficient, you tell it, I want as input the XLI. I want to see the correlation between XLI and whatever's up here as candles on your chart. Make sense?
I want to add, if you're doing that in MetaStock, it's called the correlation indicator. Very easy to apply.
Super, which is exactly what I wanted to ask, because I was trying to do it yesterday and I couldn't find it. And I know that we have.
I'll show you how later.
Okay, super important for us. Thank you very much, because we would love to do everything in one platform and not in two platforms, obviously, right? Okay, so the next thing that I want to share with you is sector performance during recoveries. So we were in a recession, the gray area that you saw early on. The curve was re-steepening. You know, we're coming out of the pandemic, March 20, that was after the Fed said we're going to rescue everything in unlimited amounts. Or we come out of the global financial crisis, March 2009. Funny how it's always March, right? I'm kidding. Could be coincidence. So let's see if and when the next recession hits, and maybe with today's webinar, you now have a sequence of events that you want to see and observe, and then you feel more comfortable going long, okay? When we're coming out of a recession, there's been research done by S&P that the top 3 sectors coming out of a recession into a recovery, we had 7 periods where that was, business activity starts to increase, the economy begins to grow again. You have real estate, technology, and industrials outperforming consumer staples, utilities, or healthcare. So here we're seeing the situation where we had Corona, we came out of the pandemic. Well, we didn't, we were still locked up for more than a year, but the market came out of the pandemic because the market realized, hey, the Fed is backstopping everybody and everything. The Fed was willing to buy high yield ETFs. I never heard that in my career, and I've only been doing this for 30 years. So you can see that the real estate sector rallied massively. One of the reasons, by the way, was that a lot of people were sick of being locked up in a city, and they bought second and third homes in the countryside if they could afford it. And that had the effect that money that was never used and always invested was now moved out of investments and put into a second or third home out in the boonies. And that actually started increasing the velocity of money. And the increase of velocity of money caused the inflation. That's another topic for another time, but a lot of people think, hey, the Fed is printing money, that's going to cause hyperinflation. Let me tell you, it can only cause hyperinflation when the velocity of money is also increasing. Printing money alone doesn't cause inflation or hyperinflation. When the money moves a lot, that is also that's causing the inflation. I'm not talking about hyperinflation in this environment. It's very difficult, as things like the Amazon effect, and now we have AI. It's going to be very difficult to create hyperinflation. Okay, and then on the other hand, you have the tech sector. And here again, you can see it's the second best performing sector historically coming out of a difficult period in the market. And so again, here you see, wow, if I see a curve that's steepening, and I'm going to take my trusted pen, I see a curve that's rapidly steepening, right? Curve keeps steepening. And I have Liberation Day that's causing these sell-offs, and I have Liberation Day that's causing these sell-offs. And then you see, it's going to take a long time until whatever tariffs may or may not hit the consumer. We're talking about 1 to 2 years. Then hopefully when you see that the curve keeps steepening, that you want to buy these pullbacks. So the first one was economic surprises in terms of economic growth and inflation. The second puzzle piece that I wanted to introduce you to today was the curve. and what it tells you about the phase of the economy where you are in. So, you know, this is, oh my God, we're coming out of the recession and we're growing. It's spring, economic growth and inflation is accelerating. And then both are accelerating, perfect. And then you have a situation where economic growth is flattening, but inflation is still high. And then both of them come down. Until what happens? Exactly, the Fed comes rescuing again, and we're doing this whole cycle again. This whole cycle, we're doing it again, over and over and over and over again. And my feeling is that what's been lately happening is we're seeing prolongated cycles. They last longer than we were taught back then in business school. On average, they used to be 4 years. They're prolongated. The pullbacks are not as deep anymore because the Federal Reserve learned after 2008, hey, we can just blow up our balance sheet, has no consequences, at least for the Fed, as long as they have the US dollar as the global reserve currency. And what I want you to take away from this is when you have this reacceleration coming out of the trough, this is where you want to be focusing on real estate, tech, and industrials historically. If you see the curve re-steepening and you see the flows, I hope you feel comfortable to then apply your correct technical analysis, whatever you may be using, comfortable that this is the right asset class in the right season, spring and summer, equities, and then within the equities, you want to be in the strongest asset class. Just like when we see the economic surprise index for Switzerland accelerate drastically north versus the one in Japan is coming off, we want to say as an FX trade, hey, we're looking at Swiss long and yen short as a possible trade opportunity. Does that make sense so far? Whitney? Yes, I love what you're writing. Great information. I need to add macro fundamentals to my analysis. I love it. Hey, Moses, so great to see you. Moses is here, one of our traders. Love it. Okay, next slide. Let's move on. The third puzzle piece that I'm bringing to you today is the volatility dashboard. So volatility signals matter. Why? Well, back in the day, we had technical analysis. We did many moons ago. And Charles Dow, the founder of the Dow Corporation, came up with, hey, there's some leading index that I can build that's leading the main index. So the S&P 500 was led by, do you remember, the transportation index. So when he saw that transportation is going up and up and up, that was like the how do you say that? The aggregate wisdom of the market was buying transportation stocks back in the day, for example, railroads and shipping companies. That was a bullish leading indicator for the S&P 500, right? So the stock markets evolved and they said, why can't we come up with options? Options are a very interesting money-making opportunity for the stock exchanges and the options exchanges. And today, these products have grown so much and so far that two things have happened in the market. One, almost 90% of all flows in the market today are passive. So the ETF market have surpassed active management. Like you used to have a portfolio manager at Merrill Lynch who you paid some fees so he would actively manage your portfolio. The ETF market has surpassed that, with the problem that today we have more ETFs than we have stocks. Okay, so the selection is gigantic. The options, the derivatives markets, futures and options, have grown so big, especially recently with the introduction of zero DTEs, that we have a situation that if you do not know in your stock or in your equity that you're trading, in the future or in the market, whatever you're trading, and there's a lot of derivatives activity, if you don't know at what price level and if these options market makers are long or short options aggregated, if you don't have that information, you are putting yourself at a disadvantage, because the derivatives markets are now influencing the cash market, or what we call the spot market. So the tail is wagging the dog for you Americans, all right? So volatility signals matter tremendously. The volatility measure of the SPX index, that's the cash index on the S&P 500. So where all of the 500 names that make up the S&P 500 are trading, that is the SPX. And then there's options on that. And based on the options, prices that are determined by the options market makers, they're determining them based on supply and demand of sophisticated institutional clients asking for options to buy or to sell to the options market maker. Based on that implied volatility, we calculate the VIX. And the VIX is the volatility index, sometimes called the fear index of the market. And what I want you to take away from this is that a VIX that's currently at, we can take a look at where the VIX is currently. I thought so. Where do I have it? Not here, not there. I put it somewhere. Doesn't matter. I'm opening up a new one. My traders know this from every Monday when we have webinars. I always forget where I move these windows. I have so many screens up. So the VIX currently is at 17.2. What does that mean? That means that with 68% probability, the S&P 500 will be trading, it's currently trading at 6,450. Okay, so you take your calculator, 6,450. In 1 year's time, with 68% probability, it will trade at 6,450 times 17% higher, 7,546.50, or 1 minus, what was the VIX? 17%, 83. So times, we're at 6,450, or it will trade 17% lower at 5,353.50. That's what the VIX means. So for a lot of you technical analysts, this might be new to you. So again, you basically, in an industry, in a profession where people like me do this all day long on the institutional side, and it's all math. And it's super unsexy, and there's no charts. There's just Excel sheets and macroeconomics and microeconomics, and that's it. And our models spit out, you're too long Aussie dollar or you're too short pound, let's go. New information, new sentiment, we need to change something, okay? This is the reality. So the VIX tells us, and this is super, super low, the VIX right now says, okay, there's only 17% upside or downside over the next year. We have FX volatility, can be a major driver of currency trends. And what's even more important, this was actually invented, or one of the analysts at Morgan Stanley, I think it was, many years back, invented the so-called VIX for the bond market. It's called the MOVE index. You can look this all up on Workspaces. It's amazing how important the MOVE index is, and it often leads the stress in other markets. This is such valuable inside information. If you do not watch volatility, you're hopefully going to start looking at volatility after this webinar, because cross-asset volatility confirms or contradicts macro signals. And I'm going to show you in a minute what I mean by that. Rising volatility means more price volatility. Yeah, the S&P with a VIX at 30 is expected to drop or rise by 30% in the next 12 months with a 68% probability. 30% is a lot more risk than if the VIX is at 10. Would you agree with me? So if the VIX is at 30, and for a trader who's in front of the screens, this could be heaven, because you're shorting or you're longing something super quick. And by the way, if you learned in the past, VIX going up means stock going down, that's wrong. It is in most of the time like that. It's most of the time that case, but it doesn't have to be. As you can see in the gold market today, you have gold volatility going up and the gold market going up. So it's wrong to say if volatility indices are rising, that means the underlying is falling. That is wrong. It just means that there's more demand for options. Either calls give you the right to buy something at a predetermined price, at a predetermined date in the future, or a put. If you buy a put, it gives you the right to sell some asset to the seller of the put, and you need to pay a fee for that right. For the seller who sells a call or sells a put, it's an obligation. And this is contractual on the exchange. You can't get out. But as you will see in a minute, to me, it's one of the best income generating opportunities that we have in the market, provided to us. It's amazing. So if volatility increases, if uncertainty increases, market makers on the institutional side, the so-called sell side, because we sell financial products to the buy side. So your portfolio manager at your insurance company is buying a bond, is buying that bond, for example, from Goldman Sachs. Goldman Sachs is creating this bond, let's say for Walt Disney, for Disney, okay, a 5-year bond and a certain coupon payment, certain yield. They're creating this bond, and then they give Disney the money, they sell the bond, and this money then they broke, so to speak, to your portfolio manager. If these market makers are perceiving, regardless of which asset class, that volatility is increasing, so uncertainty is increasing, they will reduce what they're buying or they will reduce what they're selling. So if you're calling a market maker today and you're important clients, let's say you're the Chinese central bank who continues to buy gold and gold and gold, and you're now calling your trusted sales guy at Goldman and you're saying, I want to buy more gold, with the volatility of gold going up and the price of gold going up, and one of the largest buyers in the world of gold, the Chinese central bank, buying, do you think the trader at Goldman Sachs is happy to sell the Chinese central bank more gold? No. He will reduce liquidity. That's what we're calling it. He will sell him less. The buyer will get less. So the higher the volatility, the less liquidity in the market, the less trading is going on, right? With volatility falling, uncertainty being reduced, the tariff bullshit nightmare finally ending for the whole world, finally ending, hopefully it will end one day. Yeah, with this White House, probably there's always something causing volatility. But if that uncertainty were out of the market could rise better. Okay, the market hates uncertainty. So after a macro or an idiosyncratic shock, volatility spikes and option premiums spike. I'll give you a real-time example, real-world example that we had a few months. I wake up one morning, I read the headlines, and there is over 70 people sick in the US, salmonella, because somebody somewhere ate infected burgers from McDonald's. The McDonald's stock actually tanked. Unfortunately, I think even a few people died. The minute I read that, I calculated and I sold somebody the right to sell me McDonald's stocks at a much, much deeper price level. This is after the sell-off, or as the sell-off was happening, and was generating gigantic annual returns. Okay. Of course, what happened? That's not going to kill the McDonald's stock. This is an isolated event, very bad for the clients and the customers. I'm sorry for the McDonald's people eating there who got sick, but it's not going to ruin the company. But for a few hours, a couple of days, there was uncertainty in the market, and that means volatility was increasing and options were overpriced, so to speak. And an overpriced option, I sell you the right to sell me McDonald's stocks at a price much lower than where we're already after the sell-off trading. I'll do that any day of the week. So when we have shocks, positive or negative, and volatility increasing, that means we want to sell options. When there's no uncertainty and volatility is very low, that's when we want to buy options. And overall here, we have two different macroeconomic environments. When the VIX trades above 30, there's gigantic risk off in the market. Institutions like your portfolio manager at your trusted insurance company is not really allowed to invest. The uncertainty is too high, so the activity dies down. With this reduced liquidity, as soon as a market moves, let's say gold, in a thin liquidity market, the moves will be exaggerated. So your stops need to be much, much bigger, much bigger. So if you, Whitney, for example, or less, if you haven't incorporated implied volatility in some way, shape, or form, how to set your stop, then there's room for development. There's room for you to get better. Yeah, if you're, for example, an equity trader. A VIX below 20 is better. Meaning there's more activity going on, liquidity is better. So when we're between 9 and 19, for example, everything's good. When we're between 19 and 29, there's lots of our traders, we're trading a lot, but it's more difficult for swing traders and investors because there's lots of uncertainty, less liquidity, and the moves are exaggerated. Great for intraday trading, less great for investing, except if you wait patiently for deep retracements and then go long again. If you're, for example, still in the spring, or if you're, for example, still in the summer. Do you remember a few months ago when the US bombed Iran? The VIX shot through the roof, markets tanked, great buying opportunity. The fear was there's going to be World War III. You can even wait until the VIX retraces and comes off again, and then you can buy. You can even do that. But you need to understand that these types of idiosyncratic risks or systemic risks are always great buying opportunities. The world will not end, mark my word for it. One day it will. Doubtful that we are the lucky ones who experience that, lucky or unlucky, you know. So depending on what VIX environment you have, and depending on what season you have outside, spring and summer, if you have in the spring and the summer, you have high volatility, you want to buy the dip. If you're in the winter and you have VIX over 30, you do not want to buy the dip under no circumstances. Under no circumstances. You don't buy the dip. So how many times have you read buy the dip, buy the dip, buy the dip? Well, it depends on A, what macro environment do we have, and B, what is the VIX doing and why is there uncertainty? Is this uncertainty that's justified and will be in the market a long time, or is it temporary uncertainty? Did that make sense, what I tried to tell you? Highly motivated, I was trying to convey you that message. Very good point. Andre is saying, will be interesting with this new blackout period. He means prior to a Fed rate decision, they're not allowed, the Fed members are not allowed to make comments about it. That's the blackout period. In stock buybacks in this September, ES at all-time highs, no buybacks until end of October. Jeff says, never let a good crisis go to waste. I love it. Okay, I hope the commenting function still works. You guys are very quiet. All right, and we can time income trades by reading volatility regimes. So what's the current narrative? This is taken last night when I put the slide together. Wall Street kicked off September on a sour note, with stocks joining a slide in bonds amid heavy corporate debt sales. Lots of corporates were borrowing money. That's quite interesting, actually. Why are they borrowing so much money, right? And developed world budget worries. Correct. France can't get their local budget in place. France is a nightmare. France is a new Italy, right? They can't get their politics understood. The US seems to be willing to completely, with a big, beautiful bill, completely tank their fiscal balance sheet. They don't give a shit. They're just like, let's print money, whatever. UK can't get their budget balanced at all. So this is only three. China, same issue. Globally, we have so many governments who can't get their shit together, excuse my French. If you were running your household like that, your wife would either divorce you or you'd be broke already. 30-year yields approach 5%. Bet you there's a lot of institutional buyers who are more than happy to buy US government bonds at 5% yield. They're still AA rated, happy buyers at 5%. Pressuring tech shares whose valuations have widened during a surge from April lows. I can teach you another thing. I could teach you with every sentence, I could teach you something. Tech shares originally do not pay dividends. Did you know that? Why? Because their business cases, they're growing, they're so sexy that they are beating the market return. The market return in the history of mankind for the S&P 500, which is the global benchmark for equity returns, is roughly 8.5%. So if you have a new company like NVIDIA and it's returning 100%, 80%, 50% to its owners, who are the owners, the stock investors, there's no way they're going to pay a dividend. What are you going to do with that dividend? You get a dividend from NVIDIA, who is growing at 30, 80%, 50, 80, 90, 100, 200% internal rate of return. What are you going to do with that dividend? Invest it in SPY and generate 8.5%? No. So tech companies are valued by taking long-term in the future, X years in the future, and then discounting back a hypothetical coupon, a dividend that they may pay in the future. What Apple did after Steve Jobs died, it was an innovating company. It was never paying a dividend. It was just disrupting. It was awesome. It was coming up with the best products in the world. Jobs dies, Cook takes over, and it turns into a finance company. They start stock buybacks. They don't do innovations anymore. iPhone 6, 7, 8 look exactly the same. AI, they missed. Catastrophe. But Warren Buffett was able to buy them. He said, now I can model them. Now they're not a tech growth company anymore. Now they are like a value company. I know how much they're paying in dividends. I can value them. So why am I telling you this? If long-term yields go higher and higher and higher, the future dividend that you're going to receive will be discounted because it's future dividend divided by interest rate in the future. Let's say 10 years, and the 10-year yield goes higher, or here the 30-year at 5%. Very simple example. If you take $100 in the future in 30 years time, and you divide it by 3, we can do this, 100 divided by 3, it has a net present value today of 33. I'm making this up. I'm just wanted to show you something. If the long-term 30-year yield goes to 5%, 100 divided by 5 is now 20. Do you see how that works? So NVIDIA in 30 years, when they are a value company and they're paying dividends and they're doing stock buybacks, if the 30-year yield rises, the discount that you're discounting increases, not any longer 3% but 5%, and the net present modeled value of NVIDIA is going down. This is cross asset class analysis. This might be the first time in your life that you're hearing about that. But this is the type of stuff that we're learning in business school. This is the basic, it's kindergarten before you even go to a bank like Lehman Brothers. You don't even get to be there without the top knowledge. And then who's the competition? Guys from Indian Institute of Technology. Okay, they have French guys who have 2 heads. That's how smart they are. And it's all about math. And you've never heard of, if the long-term yield goes up, that's actually affecting tech companies, because tech companies are valued by anticipated long-term dividend payments. If the chat would work, I would ask you, can I get a thumbs up or a thumbs down if you just learned something new? And that's why I started my company in 2016 when I tried to retire, because people in Germany, Austria, and Switzerland on the YouTube were talking about technical analysis. And I felt insulted. I was like, there is no technical analysis. It's math, it's models, it's understanding what asset class is moving what asset class. They're all connected, all right? So while the S&P trimmed its losses, almost 400 of its shares fell, all mega caps slipped. NVIDIA, seeing its longest slump since March, late hours, Alphabet jumped as a federal blah, 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 blah. Okay, super. So that's the narrative. While the crowd reads these headlines, we position for income. What do we observe? We're still in the macro radar volatility. Gold volatility goes through the roof. Does that make options cheaper or more expensive? Thumbs up, Jay. Thanks, Alex. My guys know this, but any of the Americans who watch here for the first time, if volatility goes up, does that make options cheaper or more expensive? And the answer is more expensive. So the MOVE index is moving up and the VIX was moving up. Okay, but gold was going crazy. So in workspaces, you have this graphical depiction of options and what their implied volatility is. So if you look at the Black-Scholes model, which is a model to come up with an options price, don't worry, I'm not going to go into it. It's too much for today. But there's certain variables, like what's the interest rate? Well, the Fed tells you what the interest rate is. What underlying are we talking about? Well, in this, we might be talking about NVIDIA as an example. Okay, how long does the client want to buy the option for? 30 days. Okay, it's a 30-day option. What strike price does the client want? Well, the client wants an option put that is 25 delta. That means there's a 25% probability that at the end of the 30 days, this option has a value. Think of options as an insurance contract, right? They either pay because there is damages to pay, or they don't pay. Then they keep the premium that they took in from you as the insurance buyer. Okay, an option is nothing less than an insurance, for example. I can purchase it as a purchaser because I want to speculate, or I can purchase it because I want to hedge something. Like if I have a lot of stocks, maybe I'll buy an SPY put because I'm worried that in September the market could sell off, right? Okay, so we said the interest rate, the underlying, the maturity of the options, the strike price, everything is given. The only thing that the options market maker can put into the Black-Scholes model, him or herself, is the so-called implied volatility. That's why professionals never talk about prices in the options market. Never, doesn't exist. They only talk about implied volatility points. Okay, that 25 put, 30 days maturity in NVIDIA, how many implied volatility points are you going to charge me for it? And then this guy is going to say 15.652. And then the client says, man, I just called JP Morgan and they're pricing me at 15, the figure, meaning 15.000. Can you get to 15? And then depending on my risk as an options market maker, I look at all my exposure, maybe I really want the trade. And then I said, I don't know. Yeah, for you, I get to 15. But please do me a favor. Is this everything or do you have more to do? I don't want you to go over now and call Deutsche Bank and do more of that because that's going to ruin my risk in the market. Okay, that's how the reality is. That's how it works. Where big trades we're still doing on the phone, everything is done electronically. So in that moment in time, what I'm telling you here is there's different information in the options market. If the puts, the right to sell somebody something at a certain strike price in the future, if the puts cost 15.65 volatility points and the calls, the right to call an asset away from the options market maker in the future, costs 13.43 points, which is more expensive, the put or the call? I don't get an answer, but I'm sure everybody in front of the screens is saying the puts are more expensive. Okay, so we have sophisticated market participants calling options market makers and asking them for either speculative reason or hedging reason for downside protection, for puts, because they expect the market to drop. You go over here and you have a market where the calls and the puts cost the same. Yeah, 6.7 volt points. No information. This is a market in balance. This could be, for example, precisely what we're doing. We're looking at two currencies that are moving exactly the same or very similar, like the New Zealand dollar and the euro. If I see that the New Zealand dollar and the euro are moving sideways, and I go in the options market and I see that euro New Zealand dollar, the calls and the puts cost the same, do you know what type of trade I have then? And I know my guys know this inside out. You go then to euro New Zealand and you have a sideways trade. So you look at it, yeah, and a sideways trade would mean to you that you're willing to see where were buyers in the past and where are sellers in the past. And the moment that you go back into the range, if you say this is the range, then you trade from range top to range bottom. Then when you come out of the range, you go back into the range, you trade from range bottom to range top. But now you do it because you have better information, because you say, yes, it's a balanced market. Even the options market makers, the second most sophisticated market makers on a trading floor, even they see no bias, neither bullish nor bearish. If we now go back to our gold example, what do we see in gold? Excuse me. Last night, as I put together the slides, I have a 25 delta put, so I can put somebody gold with an implied volatility at 16.8 volatility points. And I have a 25 delta call, the right to call away at a higher strike price at 18.73. What is this option market telling me? There's more demand for calls. It doesn't matter if it's speculative demand or if it's hedging demand. The calls are more expensive. So sophisticated market makers are calling the options market maker and asking for calls. So that's a bullish sign. Sophisticated clients are expecting the market to increase. And this with billions of dollars on the line. So this is proof that when you see that volatility is going up, like you're seeing here, that doesn't mean gold has to drop. The next step is that you look at what's more expensive, the calls or the puts, and the calls are more expensive. Then you go ahead and you look at, all right, in the future, this is December 19 of this year, where do you see the most calls? And last night, the most calls in the asset GLD, that's the ETF on gold, was at 370, so $3,700 in gold. Did you just learn something new? I hope so. This is all information in Workspace. This is information that we use all the time in our firm. And then we go ahead and we say, we're not chasing gold, we're waiting for gold to retrace, okay? And we're seeing a long consolidation period, and gold just broke out, and today it's going even further. And last night when I calculated it on the closing price basis, if I wait for gold to come back to its breakout level, 317.63, it's very hard for you to see, but I crunched the numbers. Gold was closing at 325.59. I want to sell somebody the right to sell GLD to me at 318. And the price was $7.30 yesterday, $7.20, sorry, $7.20. And that comes out to an annual yield of 7.83%. Now, in all honesty, I don't trade anything under 12% per year, and I try to go between 12 and higher. So my portfolio, where I'm doing these types of trades, grows every year 12 to 24%. That's a target. Sometimes more, but it's very conservative. I wait for situations like that that makes sense macroeconomically. In this case, basically think of it like this. You are getting paid to wait $720 until gold retraces to your entry level, where you want to buy it. How great and sexy is that? That's better than just putting a buy limit in and then waiting until year end. So we understand the macro environment. Many countries on earth are unable to balance their budget, meaning tariffs and governments borrowing money will increase prices. That is inflation. Inflation is expected to go higher, okay? Gold is fighting that. Gold is also symbolizing that the Trump administration is attacking the White House, and for the #1 economy in the world, for the #1 central bank in the world, it's doubtful if independence is going to remain or not. Historically, and this is so nuts about it, the tariffs historically are massively inflation, okay? Central bank independence was introduced. Why? Because it actually fights inflation. Now, all of that is forgotten. People get dumber and dumber, all of that is forgotten, and we're going to have to relearn the lesson. And the sad thing is we're probably going to have to relearn the lesson what a world war means as well. I'm not trying to ruin your week, okay? It's only Wednesday. But it's very, very sad what's happening, because what the US is implementing right now is changing everything back to how it was a long time ago, a very long time ago. I could give you a whole history lesson, and I did on YouTube about tariffs, and I could do another whole YouTube instruction just on why central bank independence has been proven in the past to be actually a sensible thing, and not to let politicians tell you, the central bank, where the price for money should be. But it's also true that the central bankers are non-elected officials. So there's both sides have arguments. Anyways, I'd rather generate 7.83% than chasing gold to the upside when implied volatility is high. So in closing, after almost 2 hours, and I think Jeff wanted me to do 2, when we go from macro signals to cross-asset trades, we gave you an example today of looking at 2 different city economic surprise indices and city economic inflation surprises. We saw a deceleration in the US and an acceleration in the UK. We even broke it down and said, wow, the UK is in spring, economic season, so to speak, and the US was in deflation at the time. So cable long was the trade to do. Then we looked at cyclicals and how commodities benefit in a yield curve steepening environment. You learned that historically, right after a recession, you want to be in real estate as an ETF, for example, XLRE, you want to be in tech, XLK, and you want to be in industrials, XLI. You also learn to look at a steepening yield curve in XLI versus a correlation coefficient. And you learned that when the curve is re-steepening and you see a correlation coefficient that was wrongly negative going to correctly positive again, you want to look for buy signals. And lastly, we looked at volatility. You learned that increase in volatility does not always have to mean a market is tanking. You maybe have learned for the first time what VIX 30 actually means. Exactly with 68% probability in 1 year's time, the current S&P 500 may be 30% higher from today's close or 30% lower from today's close. And then we learned that we can look at the skew to gain additional information if a asset that has options actually has a bullish or a bearish expectation / bias to it. And you may have learned that, hey, I can actually get paid for my buy limit. You also learn to put the VIX environment into its season, that a VIX from 9 to 19 is very investable, from 19 to 29 is very choppy, liquidity gets thinner, and above 30 is no institutional investments are going on. Everybody waits for the Fed to come rescue or for somebody to calm the market down. So the sequence of events for us is macro, determines which asset class performs or underperforms. Couple that with the volatility and an event, and that determines our trade. So we have a lot of conviction when we trade. And what I invented 2016 for my own money, and which I ended up teaching, is the FIST process, which is fundamental analysis, inner market analysis, sentiment analysis, and technical analysis across all asset classes, because they all give you information: bonds, currencies, commodities, equities, volatility. It was us at Lehman Brothers who introduced volatility as a tradable new asset class, and crypto. Crypto is a new asset class. It's part of the regime now, of the environment, sorry. And all of that is embedded in risk management and psychology. Besnick, one of our best traders, could give you every single of his trades live in a webinar, live, and you could still lose money. If your upstairs is not locked in and you don't trust yourself, you will not follow his 3 winning trades. Then you get fear of missing out. You follow his 4th trade, and that is his loser. You losing money, you get depressed, and you change rooms and go to the next guru. Sounds familiar? Exactly. There's a lot to learn in this business. So the key takeaways for us today: MetaStock Workspace gives us tools like CZ, yield curves, volatility, news, endless information. When we have the cross-asset translation that can turn into our signals, we can take high conviction trades, and some of our trades will generate income until they even manifest. And don't just react to the markets. Anticipate which macro signal is hitting, and then follow the flow. If you know after we come out of a trough economic recovery, we call it spring, and you see, hey, I should be long real estate and tech and industrials, and then you see these assets perform, then you use your correct technical analysis to follow the long, and you play it for a while. and you can use volatility and the curve, as well as the economic calendar and workspaces to tell you if things are changing. So if you want to try this, Jeff is going to send a link. It's very reasonable. You pay for 1 month and you can try the platform for 3 months, and we can even give you our templates if you want. And one of our sayings in our company is trade smart, live free. If you want to learn more and you speak German, come to our YouTube channel. These were recent trades that we published without giving investment advice. I'm not allowed to do that. I'm not even allowed to teach anymore in Germany. Everything is forbidden in the socialistic regime. But if you want to learn how to trade smart in these markets across all assets, then go and become a global income investor if you speak German. I'm on my way to Germany. I just did this for Jeff and MetaStock because I love them so much. I'm out of here in 48 hours on a plane to Austria from September 18th to 20th. We are actually going a lot more into depth. So unfortunately right now only in German. And if some of you speak German, you want to get to know us, we have just a one-day event where we also add value. So Jeff, after 3 hours, I don't know, I apologize. My guys know this. When I say an hour, it's usually 2.5. Sorry for that. We can check that for the future. But if you're still there, I'm going to hand it off to you. And I want to say special thanks to the guys from my team who were here today, and very special thanks to the guys on the MetaStock YouTube, on the MetaStock mailing list, Tom, Roy, Rod. Awesome that you guys participated today. Maybe a little bit different of a webinar, but hopefully one where you felt that you got some value and some new insights in this very, very complex business, which is, in my opinion, the best business in the world. I love our profession so much. So back to you, Jeff.
Yeah, it's okay if I ask you just a couple questions from YouTube?
Yes.
Okay.
100%.
Robin wanted to know, when you talk about cycle theory, are you referring to Hurst's 7 principles of commonality?
Referring to what?
Hurst. 7
Hurst
principles.
cycles.
Yeah.
Yeah. And what is the question?
When you talk about business cycles, you're referring to Hurst cycles.
No, when I'm talking, well, there's 2 different things. There's the credit cycle, there's the business cycle, and the Hurst cycle is something that he came up with that is more technical analysis. Yeah, it's also cycle analysis, absolutely. And they go into super, super long. There's a great book on it, which I don't know the title of it right now off the top of my head. The business cycle and the credit cycle and then the stock market cycle, these are all cycles. What I would like to answer to you, what was the name of the guy who asked the question?
Robin.
Rob, what I would like to answer to you is no, they're not the same. This is different. What's important to note is that the markets, the financial markets, are front running the current economy. And the problem is that no model in the world, Rob, knows by how much. Okay, so when in March of 2020, the Fed came and backstopped everybody, we were sitting at home. I was sitting at home, at least. I can only talk about myself, Rob. And I didn't know if I'm going to die or not. Everything was so new. I was locked up. I was doing emergency purchases. There was no vaccine, whatever, you know. I had no idea. And the market were rallying towards all-time highs. What had they done? They looked in the past. They, meaning sophisticated investors, looked in the past. They said, how frequent are pandemics? How long on average lasts the pandemic? Because the market are super intelligent. Oh, the Fed is backstopping everybody. So there is destruction in the real economy because there was no trade, nothing was going on. There is destruction, but the factories and the people will survive. So there's going to be gigantic base effects. So the markets were rallying towards all-time high because they were trading the future. The future can be anywhere from 3 months to 24 months in the future. Again, Rob, nobody knows exactly how much in the future does the market discount at any moment in time. But in March of 2020, they were discounting the future 18, 24 months in the future, everything will be fine. So that's something that I would love for you to hear and hopefully understand as well, that the markets are front running. So the market may be tanking long before you lose your job. Hopefully nobody will lose their job, but I'm just trying to say that, yeah? So there's always a disconnect. So the business cycle is slower than the market cycle. Okay, next question.
Robin wants to know, I think we have time for one more. What fundamentals do you mostly use to evaluate the fundamental value of a stock?
Okay. All right. So very good question. I always, and institutionals work that way, we go strength versus weakness. It's very rare. Some mandates have to do that. You don't have to do that. What's the name of the person who asked the question?
Robin.
Robin. Okay. Robin. The first thing that I do is I look at the strongest economy. Let's hypothetically say Switzerland. Within Switzerland, I would look at the strongest asset class. Let's say that's stocks right now. Within the stock market, I would look for the strongest sector. Let's say that's, for Switzerland, manufacturing. I'm making this up, all right? Within the manufacturing sector, I look at, hopefully they have an ETF. Hopefully they had an ETF, because what did we learn today? ETF market is larger than the old school market, single stock picker, right? So you want to be in a stock, if you are in a stock that's in many, many ETFs, because that means it has coverage by analysts and it has liquidity. All right. And now your question is, now we had the whole background. So it's summer, it's the right sector, it's the strongest stock within the sector. Now, again, you look at, for example, a service like Zacks, right? Zacks goes only by what analysts are rating the stock like. Analysts are proven to be late to the party and biased. So maybe that's not the best thing to do, right? To go simply by the analyst rating. The stock market works, as I tried to allude to earlier on, based on really vague, strange models like dividend discount modeling, with lots of assumptions in it. When I studied at a university, I thought that's nuts. That's why I became a bond trader. Anyways, you want to model revenues. You want to look at the expected development of revenues. So strongest stock, strongest industry, expected development of their revenues, and then the expenses. Why am I saying that? How can you make money? Robin, just imagine you have a company. You can either make money by selling more, or you can make more in terms of bottom line by reducing your costs. Would you agree to that? Best case, you do both, right? Okay. And then we could go on and on and on. I don't want to make it too complicated, because what your question specifically was, if I look at a stock, what fundamentally do I look at? I look at the strongest expected earnings growth and the best expected cost management growth. Important to me is that it's in the strongest sector, and important to me is that it's the strongest stock in that sector. And you know what can give you a hint that it's the strongest stock in the sector? The earnings per share. The earnings per share, the higher the multiple, the stronger the market says is the quality of that company's earnings. So again, it's something that for retail traders maybe who read a lot, who studied a lot, who are on value investing newsletters, complete opposite of what you learn. There you're taught to buy the deep discount with a margin of error and the lowest earnings per share. No, you want to have the one that has the highest multiple, because the market is telling us, you and I, in its infinite conglomerative knowledge, the quality of these earnings and of the expected earnings are super, super good, versus the low earnings per share multiple, where the market is saying, this is a dog because it's a dog. The quality of the earnings is really, really bad. So that's maybe, Jeff, one last piece of nugget that I can hand out to you guys, so you have an understanding that you actually don't want to argue with the market. earnings or multiples by in and of itself are not a reason to engage in a trade. I can tell you that. That's a one-factor model. No model works on a one-factor model. You need more. And long answer, I hope I was able to answer it somewhat to so that it hopefully adds a little bit of value to you, Robin. I hope so.
You did great. That's amazing. I really appreciate it. That's probably one of the, I've learned a lot more in this webinar than I usually do. So Jay, I want to say thank you for coming in here and spending some time with us.
2 hours. Sorry, Jeff.
No,
I hope you let me come on in the future. We'll see.
Of course. Anytime, dude. That was great. I appreciate it. So if you speak German and want to learn more, you can go to libertybrothers.com. And if you want to get the extended trial for MetaStock, the link is in the chat, metastock.com/jmedroek341. Give us a call, 800-882-3040 if you want to talk to us, or metastock.com/saleschat. Thank you again, Jay. Appreciate it.
Thank you, Jeff. And thank you to the listeners and viewers of today's webinar. Thank you for giving us your time, and hopefully it was a little bit value adding to you. I appreciate it. Thanks.
Very good. Awesome. I think I only wish I could give it another thumbs up.
Thank you. I appreciate you, Jeff. And thanks for everything that you did for us and our team. Really appreciate you guys, and give my best to your colleagues, please. We really, really appreciate what you're doing. Thank you.
Same. Great job, Jay, as always.
All right. Talk to you later. Bye-bye.
Right.
Bye,
Stay
guys.
well, everybody. See you next time.